Welcome back to the Snod Pod with Jon Snodgrass, your mortgage resource where we're talking mortgages, real estate, and beyond. I've got interest rate enthusiast, one of my economic advisors, philosophical advisors, old friend, Mike Aiken here. The Mike Aiken from Whitefish Bay. I just wanted to bring you on because I usually check with you. When I'm doing some investments for the last 20 years, you seem like you got a pulse on a lot of things. So I just wanted to bring you in. Thanks for coming in.
Yeah, well, thanks for having me. Yeah, I'm just kind of an amateur macroeconomic thinker, and been following this stuff for probably since the Great Recession is really where I got interested in it. And I've been following it ever since and kind of watching it play out. And so, I've got some takes on the market. I don't know if they're right or wrong. But
well, I just remember going back into the COVID years, we talked early on and you were, a prognosticator. You're like, Jon, these things are going to go below 2. And you kind of called it right. So we'll see where you go this time. But I thought we'd talk a little DOGE. Just curious your take on that. I know it's a little controversial, but I'm just curious what your thoughts on it and if it's going to help or not. Or
yeah, I have.
I'll let you just roll and I'll jump in.
Two sides of the DOGE equation. I think you kind of have to look way back in terms of the path that got us here to where we're having to make some really hard choices, and there's not a lot of good choices, but I'll try and kind of speed it along. So I think in 2008, 2009, there was a problem of low growth and high debt, and that came to become a deflationary bust. And after that, there's still the problem of no growth, and you had to reinflate the economy. And so you had, President Trump throwing a lot, and you're really using the stock market, in my opinion, as a scoreboard for the economy. We kept interest rates really low at 0. A lot of people went negative. You're talking about major tax cuts, so you're putting a lot of extra cash out there, and then just the fiscal spending with COVID. And the market really got juiced. Stock market went to all-time highs. And then you had Biden, as there's still a growth problem, and I think we're kind of was running on a bit of fumes during the Biden administration, but they started throwing more and more fiscal at the issue, and it's a very powerful force, and it kept everything going. And again, juicing markets, essentially until the inflation problem from the prior attempts to cure really rearing its head, and that inflation's not only due to currency debasement, but also the supply shock. So there's kind of multiple aspects to it. And, now with COVID and that inflation coming in and having to raise interest rates at the fastest pace in history, we're now at a point where, you really can you've got really 3 things. You've got the stock market, interest rates, and the dollar. And a guy I follow closely is Luke Groman, and he always says you can have 2 out of the 3, but not all 3. Right now, we've got all 3. So I don't think the regime we're in right now is very stable. And when you look at it, one of those things has to fall. And in my opinion, it's got to be the stock market to fall.
Okay.
Because I don't think that they can lower rates with inflation still going way above target. So
even though President Trump is saying, "Hey, I'm going to make sure that
rates go down,"
I mean, I don't.
Well, that's
just more talk.
This is part of the transition. So the scoreboard used to be the stock market.
Yeah.
The stock market's at all-time highs. I mean, it's the most expensive stock market, or tying the most expensive stock market since 2000. And so you can't cut interest rates when the stock market's that high because you've got the inflation problem. So now what Trump and Elon are trying to do is target the 10-year, because that's what mortgages and everything are based on.
10-year treasury, yeah.
Yeah, so they need that to come down. So how do you do that? And in my opinion, there's only one way that's going to happen right now, and that's for the current stock market regime, Mag 7 or whatever, to stub their toe and probably, in a pretty big way, and that's going to bring interest rates down. I think that's the only way that they can come down. And right now, to get back to the DOGE question, so A lot of the fumes that Biden was using to propel the economy forward were government jobs. So the government sector was blowing out. And that was accounting for a couple percent of GDP, and now that's going to be removed. And I think the thing that, and then you also look at the labor shrinkage, from closing the borders, kicking out all the cheap labor. I think that's going to have a potentially negative effect soon. And it's not going to take much, with markets where they are, to me, to have, a big wobble. And then, I think that's going to bring interest rates down. When that happens, I have no idea. But I see, as these things feed through, to me, the stock market's going to go, and then interest rates will follow.
So going back and super, interesting take there, but jumping back to something you said before, where you think the stock market's got to stumble, or the Mag 7's got to stumble. Can you tell me about the Mag 7?
Yeah, and right now, I think the Mag 7, it kind of shifts what stocks are in there, and I suppose you throw all the AI plays in there right now. Apple, Nvidia, Amazon, Facebook. Throw Tesla, Netflix.
Which have all been, Facebook was recently at an all-time high. It's been stumbling here, dropped like $100 a share recently.
But looking at how the DeepSeek, when that came out, and now Alibaba is open sourcing a lot of their models, which is going to be presenting a profit problem for these companies, at least a narrative problem for what they're saying is that this growth is just going to keep going up and up and up. And so I think that's deliberate. And so, and I think, to me, it's not going to take much for those stocks at all-time highs, trading super expensive, aside from maybe Google, whose business is getting disrupted by, all the language model stuff. But it doesn't take much. To me, I analogize it to if you're climbing an Everest and you get above the certain point, the death zone. It doesn't take much to stumble, and I feel like that's where we are right now. And so, is Elon's DOGE and the labor part of things gonna be enough? I think it could. So let's see what happens. But I guess the timing is anyone's guess. But I'm guessing this year, I could see rates heading down very quickly.
Very quickly, okay. What do you think, what is the impact going to be of DOGE? Is it going to be that huge of an impact to the economy?
I think it is, yeah. Because, especially if you look at the relative history of where was the growth coming from, the job growth was coming from the government. You strip that away, that's the incremental growth is what prices markets. And if that goes away, and at this valuation, does everyone keep piling into the same stocks and piling into these, the U.S. where, versus the rest of the world, which is, it's never been, more of an outperformance. So, those are trends that, need to change. The deflation into inflation trend changed in COVID. Does that start changing now? I don't know. I'd still want to invest in the U.S., but, they've got a rocky transition to get from here to there, where you're going to have all this AI-driven growth. I just don't understand how you phase transition into that AI-driven growth without some sort of deflationary event, in the meantime.
So does the narrative switch for the barometer of success, going from the stock market is the way we look at success? No, I hope get interest rates down. That's the barometer of success.
I think it is.
That's the goal of the administration, in your opinion?
Yeah, and it's not just me. So I'm kind of taking aggregated sources of all the smarter people that I listen to. But I think that has to be because not many people own the stock market, you know, and everybody's got to pay for a house, and people are getting, really squeezed right now. And so I think it's the right thing to do. I think the stock market, should come down. Does that mean you sell all your stocks right now? No. You want to be diversified and do what you can to make sure that you're prepared for however this goes, and try to be opportunistic and rebalance. But yeah, I do think that is a huge change, where the stock market is no longer something that, if the stock market doubled from here, I think we'd all be in a much worse place, because inflation's going to come back, right? and you can't cut interest rates. So it's something's got to change, in my opinion, and that's likely the stock market and then interest rates to follow.
And then the interest rates ideally will drive economic growth.
Yeah, I think they need to burn it down,
Yeah.
and then they have to build it back up. And
Yeah.
that's something that Elon Musk, however you feel about him, that's sort of what he does. He's willing to take the pain in the short term to get a long-term gain. And, that's what he did with Twitter, and it looks like that's what he's doing with the U.S. government. Is that the right way to go? It's going to be painful. I mean, you're talking about really like austerity,
Right,
and
yeah, a lot of loss of jobs. I mean,
right.
it's not...
And you talk to people. I don't know anyone who's lost a government job, but I just talked to a bunch of people yesterday. We're in the room, and everybody knew somebody. So,
right, yeah,
it's affecting people,
Yeah.
and I think it will, have an
easier
impact.
for to theoretically say, hell yeah, we just got to do this to push down interest rates and create a better economy. But like if you're the one affected, you're the one working at a you're a ranger out at
Exactly.
a state park, federal park. It's tough to take that kind of
But the thing
medicine,
is,
if you will.
no one has been willing to take the pain, and that's what's gotten us here.
Got it. So
And
at some point, the
you've got to. I mean, I think what they had to do because of the debt situation. I mean, you have to get that under control.
Yeah. It's
Otherwise, you're looking at runaway. You're looking at runaway inflation. So, it's a difficult situation.
Mm-hmm.
And it's been the 20 years, or 15 years since the Great Recession, keeping rates at zero.
right.
Now we have the huge money printing during COVID, and now we have inflation, which we didn't think, we were going to have. But we also have a low growth environment. It's just a very, very difficult situation. But I do think rates have to come down. People need to buy houses.
Yeah.
And right now, I mean, house affordability is at its all-time low.
Yeah.
So that hurts, I think, more people than a high stock market.
I mean, I would say this cautiously.
Than a lower stock market.
Yeah, cautiously, that it's good news to a degree, unless you're the one affected by what's going on with the cuts at DOGE. But I mean, it's welcome. I hope you're right as far as interest rates coming down, because it would be nice to get more people back in the market.
Yeah, and I think it's at this point again,
and
it's
get
really
some more supply, perhaps.
Right.
Maybe because I think there's a lot of people in the housing market that are stuck, not necessarily stuck. Hey, they've got this 2 whatever rate or 3% rate, and
That's me.
Yeah,
I can't move.
Yeah.
You can't move because the cost is just so much higher, and who wants
it's,
that? If
it's
you can
almost
avoid it?
it's like 2.5 times. I remember I did like a analysis because my wife wants to build a house. I'm like, we got 2.6. Come on.
Right. It's hard to do. I mean, you want to please your wife, but they're. Yeah, I mean, they're. Yeah.
Yeah. But even if I think if we came down into into the fives, I think you'd see a lot of the baby boomers who may have a small mortgage and they may need to take out a small mortgage on a new house. A lot of them probably have it paid off, but I think it's easier to take 5 high 4s versus 7. And then we might get some more supply on the market. Out on the market, and then it's like, okay, well then prices can stop appreciating at 20% a year in Whitefish Bay,
Right.
Or Wauwatosa or whatever it's been. I mean, it's just been nuts.
Yeah.
We need that. So
it's a difficult spot.
Yeah.
But I think the good news is for lower prices is that the whole younger generation has an opportunity to get a foot in the door.
Yeah.
The stock market versus an hour wage has never been more expensive than it is today, and that just seems like a lot of the policies for the baby boomers. At some point you gotta reconstruct that to be more fair for everybody, in my opinion.
Yeah, because the baby boomers have probably the most invested in the stock market for the longest time, and they're the ones that
right,
benefiting the most.
Which is a lot of the reason why I think, and the boomers are. I think if you talk to people, I mean, they're very overextended into the market, and the market hasn't gone down, for an extended period for a really long time, since. And really, a long time. I mean, because it's been essentially, a quick V back up.
Yeah.
So they would get really hurt.
Definitely want to
if this is so fragile.
Pulling back.
Yeah, absolutely. And then if interest rates go down, obviously bonds do well. So.
Well, hey, I'm glad you could come on because you and I get into these long conversations, and I love hearing what you have to say. And I've been obviously leaned on you over the years. I guess full disclosure, you are not a financial planner.
Yes, I know nothing. I am just an armchair participant.
But like you have been right so much, and it's like you watch the CNBC or Fox Business, like they're wrong. I feel like way more than you have been. So I just thought it would be fun to bring you on, and people can listen and take what they will. But
right now, so many things could happen, and there's so many options that are getting on the table that if you're someone like me who's just an enthusiast, it's a really exciting time. Also, a pretty terrifying time just to be, alive. But
I like your summary of you think you could see interest rates coming down pretty quickly latter part of this year. So I'm going to take the positive from this.
Exactly.
The Michael Aiken from Whitefish Bay, philosophical advisor, economic advisor, and interest rate enthusiast. Thanks for coming on the Snod Pod,
thanks
man.
for having me.
Yeah.
My first time.
You're sticking around. We're going to do a platform tennis, a fun episode after all this scared the hell out of everybody episode. All right, this has been the Snod Pod with Jon Snodgrass, your mortgage resource, where we're talking real estate, mortgages, and beyond.